negative beauty contest. The question is, which country is the ugliest? And for a while, the U.S. was winning that contest, hands down. We had really bad economic policies. But then Europe decided to compete. And right now, I think it's winning. And the result is that when Europe exchange rates, it's the relative price. When everybody is so pessimistic about Europe, the euro goes down, the dollar is stronger, and that means U.S. exports are having troubles. But it's not just a negative sum where one country gets an advantage relative to the other. It's actually a negative sum game because the uncertainty of this volatility in exchange rates is bad for everyone, actually has adverse effects on investment. Of course, when exports are weak and when consumption is weak, investment will be weak. And so with consumption weak, with investment weak, with exports weak, the only answer is government. And government did step in to fill in the gap. And it did this through a global Keynesian stimulus. It should be clear, it worked. Without the Keynesian stimulus, the world would have faced, I think, a global depression. In the case of the United States, without our stimulus, our unemployment rate, instead of going to 10%, would have been probably 12%. But the unemployment still did go to 10%, and the reason was very simple. The U.S. stimulus package was too small, and it was not well designed. Too much was spent in ineffective tax cuts, obviously with people burdened with the kind of debts that Americans were burdened. It was clear that they would not go to the shopping malls and spend. And there was also too little aid in states and localities. The result is that while the federal government was spending more, the states were contracting, and we have this anomalous situation where states are laying off workers. Premier education institutions like University of California are putting the teachers on furlough 2 days a month, or on the way to laying off teachers. The one country with a really large stimulus relative to its GDP was China, and it resumed strong growth. China and India have managed, at least temporarily, to have growth even when the rest of the world economy is weak. But they are too small economically to save the rest of the world. I should comment that the Australian stimulus was not only timely, it was actually one of the best designed stimulus packages of any of the countries of the world. And the result of that is that Australia had, among the advanced industrial countries, the shortest and the shallowest of economic downturns. Well, in the United States, we made a big economic and political mistake, and similar mistakes were made in some other countries. We left those who had created the mess in charge, both in politics and the banks. And the reason why I say it was a mistake is that it was very difficult for these individuals to admit easily the magnitude of the mistakes that they had made, difficult for a Secretary of Treasury who had previously been in charge of one of the financial institutions, who had been responsible for the bad lending, to say, boy, did I blow it. And so they were all trying to minimize the significance of the mistakes that they had created. And you can't change mindsets that quickly. The people in the Obama administration, among the people in charge, are the people who were responsible for the deregulation that caused the problem that we faced. They also had an incentive to hide their mistakes through continuing faulty accounting and hidden bailouts, practices called pretend and extend, so that people wouldn't the banks wouldn't have to face up to reality. In a sense, they wanted to believe that the bubble was the reality, that the economy was going through a temporary bump, that the breaking of the bubble was a nightmare. But in fact, of course, what the bubble was a fantasy, and the reality was where we were moving towards. So their basic economic strategy was to give the economy a little bit of assistance, enough to get over the current bump, don't change things too much, and the world could go on as before. But one of my main points is to argue that we can't go back to the world as it was before 2007. We had a very badly distorted economy. One indicator was 40% of all profits were in finance. Profits, the financial sector is supposed to be a means to an end. It's not an end in itself. You don't eat finance, you don't wear it, you don't do it. It is the justification for finance is that it helps allocate capital, allocate resource, manage risk, and if it does its job well, then the economy is more productive, we all grow faster, and in return for that contribution, they get a fair return. That's the way things are supposed to be. But somebody who is facilitating the growth of others, to get them to have 40% of all corporate profits is at least suggestive that something was out of kilter. And even more so when they were getting profits when they weren't doing what they were supposed to do. They didn't allocate capital well, they misallocated capital, they didn't manage risk, they created risk. So the financial sector was not only bloated, it had failed to perform its essential functions. Much of the innovation that they continually talked about was directed at circumventing tax, accounting, and financial regulations, not at enhancing the productivity of the economy. Paul Volcker, who was the chairman of the Federal Reserve Board before Greenspan, recently commented that the only financial innovation American financial markets have made that increased our productivity was the ATM machine. But he was wrong, because the ATM machine was actually invented in the UK, not in the United States. In a sense, what we've been seeing is a slow train wreck. In a way, as the bubble began, as the bubble grew in 2003, 4, and 5, you could see things getting developing and visions of what was going to happen became clearer and clearer. The consequences of the bubble were predictable, and they were predicted, though not by those who believe the markets always work, because people like Alan Greenspan, when asked about a bubble, said, oh no, there's no bubble, because he believed the markets could not make a mistake. He said there's just a little froth in the economy. But after the bubble broke, it was clear where we were going to go. There was going to be an economic meltdown, a weaknesses in aggregate demand, and a financial meltdown. The banks knew that they had been engaged in massive deception of moving things off balance sheet, so the regulators couldn't tell what was going on. That was part of their innovation. But as the crisis developed, at that point, they knew that they didn't know their own balance sheet. So they knew that they couldn't know the balance sheet of any other bank. They knew that there was no reason to trust themselves, so they knew that there was no reason to trust each other. And that was, in a nutshell, why the credit markets froze. Nobody would trust anybody else for good reason. And the only reason that credit started to flow again was that government set in and said, we'll back these people up. And what really caused the meltdown after the Lehman Brothers was very simple. The Secretary of Treasury said, well, maybe government won't back you up. And once it became clear the government wouldn't back you up, the whole private sector collapsed. But it was only the government guarantee that had kept things going as they were. But this economic meltdown and the financial meltdown, although they're related, are really distinct. And the US and many other countries made a crucial mistake focusing on only one of these two, focusing on the financial sector, assuming that if they could fix the financial sector, everything else would be solved. They didn't fix the financial sector in the right way, and I'm going to come and talk about that. But because they only focused on the financial sector, and they didn't even save the banks in a way which helped restore the broader economy to strength, and the result of that is, as I say, this prognosis that I have of a long malaise, a very long period of slow global economic growth in the United States and Europe particularly. Well, let me say a few words about saving the banks. The focus was originally on saving not just the banks, but the bankers and their bondholders and their shareholders. And this broke the ordinary rules of the market economy. We have clear rules of what happens when firms go bankrupt. They can't pay their creditors. You can't pay your creditors, you go into bankruptcy, and the bondholders become the new shareholders. Banks are just like that, except for a couple minor differences. One of them is because deposits are insured, the government plays a more important role. Because finance is so important for the economy, you're more likely, you want to make sure that the financial system remains stable. And you don't want to wait until the bank is really bankrupt. To put it another way, when you put your ATM card into to the ATM machine, your card into the ATM machine, and it says insufficient funds, you want it to be because there's insufficient funds in your account, not because there's insufficient funds in the bank. So that's why we try to shut down the banks before there's insufficient funds. Well, we have laws about how that's supposed to be done, but the Bush and Obama administration broke those laws effectively. And what they did is, rather than applying the standard rules of conservatorship, what they did is they bailed out the bankers, the banks, and the shareholders. This is a system that I call ersatz capitalism, where you socialize the losses even though you will allow the privatizing of gains. And this system distorts incentives. It is not the basis of an efficient market economy. But the other problem was that no conditions were put on the bankers. And so, not surprisingly, they followed their own incentives. Their incentives were to take the money. We had allocated $700 billion to take the money and pay them out in bonuses and dividends rather than to make them available for credit. And the result of this is that while the intent of the mega bailouts was resumption of credit, it hasn't happened. Credit today is substantially lower than it was before the crisis. Moreover, the way the banks were bailed out, basically gifts, the country's fiscal position is worse than it otherwise would have been. Much of the assistance was hidden, for instance, by lending to them at zero interest rate and allowing them to invest, to gamble. I mean, many of you are business people. I'm sure if the central bank lent you money at zero interest rate, you could figure out a way of making money and claiming that you were very smart. And that's what our banks have been doing. And the government's also been engaged in restructuring the mortgages by taking the bad mortgages off the books of the banks and putting them on the books of the government. But as I said, the issue is there's both a financial crisis and an economic crisis. And we have to look beyond the financial crisis, because what's affecting most Americans and most people in Europe is not just the financial crisis, but the fact that they can't get jobs.